McDonald's Corporation. The world's largest quick-service restaurant chain, over 40,000 locations across 100 countries, serving approximately 69 million customers every single day.
MCD is a franchise royalty machine. 95% of locations are franchisee-owned, letting McDonald's collect rent and royalties while deploying very little capital.
The story begins in 1940. The McDonald brothers opened a hamburger stand in San Bernardino, California. 15 years later, Ray Kroc launched the modern franchise model from Des Plaines, Illinois.
McDonald's IPO'd in 1965 as the franchise system crossed 700 locations. The 2003 I'm Lovin' It campaign launched a decade-long turnaround that restored same-store sales growth after years of decline.
All-day breakfast in 2015 reignited U.S. traffic. By 2021, digital sales exceeded $18 billion globally, and the My McDonald's Rewards loyalty app launched across the United States.
Franchised revenues account for 59% of McDonald's top line. Royalties based on a percent of sales, plus rent on the properties McDonald's leases to franchisees and subleases to operators.
Company-operated restaurant revenues represent the remaining 41%. Food sales from the roughly 5% of locations McDonald's runs directly, primarily used as training and innovation testbeds.
Gross margins run approximately 57%, well above most restaurant peers, because franchise royalties and rents carry nearly zero food or labor cost.
Operating income hit $12.4 billion on $27.9 billion in revenue last year, a 44% operating margin that makes McDonald's one of the most profitable franchisors globally.
Yum! Brands, KFC, Pizza Hut, and Taco Bell operates a similarly asset-light franchise model with 53,000 locations globally, primarily in categories where McDonald's does not compete directly.
Restaurant Brands International, Burger King, Tim Hortons, and Popeyes, is the closest direct competitor in the burger segment, with strong franchise economics but smaller U.S. market share.
McDonald's moat is the combination of global brand equity, best-in-class unit economics, and a digital loyalty ecosystem that now drives over 30% of sales in key markets through the app.
McDonald's footprint spans over 40,000 restaurants in more than 100 countries, the densest quick-service restaurant network on Earth, with drive-thrus accounting for the majority of U.S. transactions.
The United States is the single largest market. International operated markets, UK, France, Germany, Canada, and Australia, are the high-margin franchise geographies. Asia-Pacific represents the long-run unit development opportunity.
Chris Kempczinski has served as president and CEO since 2019, having led McDonald's USA through the digital and delivery transformation that became the Accelerating the Arches strategy.
Kempczinski's strategy centers on three pillars: marketing the core menu, committing to digital and delivery at scale, and expanding the restaurant footprint, especially in underpenetrated international markets.
McDonald's, the world's largest quick-service restaurant franchise, 40,000 locations, 69 million daily customers, and a royalty model that converts more than half of revenue to gross profit.
Q1 2026 beat on both EPS and revenue. Traffic recovery, value platform performance, and digital loyalty penetration in a cautious consumer environment are the central questions. Full episode out now.
McDonald's just handed the market a rare combination: a comps beat in a tough consumer environment and an earnings beat in the same quarter. Global same-store sales grew 3.8%, with U.S. comps at 3.9%, and adjusted EPS came in at $2.83, 9 cents above consensus. For a company trading near its 52-week low, Q1 2026 is a credibility moment that demands attention.
McDonald's is the world's largest quick-service restaurant chain by revenue and system sales. Over 40,000 locations across 100-plus countries. The model is primarily franchise-driven. Roughly 95% of restaurants are owned and operated by independent franchisees, generating royalty and rental income that flows with near-zero capital from McDonald's corporate. That asset-light model produces extraordinary operating margins north of 45% and free cash flow that has funded decades of dividend growth.
The financial signature of this model: $6.5 in Q1 revenue at a 57.5% gross margin, a 45.3% operating margin, and 7 points in trailing 12-month free cash flow. These are numbers that most restaurant businesses can only dream about. The system is a cash machine that also happens to sell hamburgers.
Q1 2026 revenue hit $6.52 billion, up 9.4% year over year and $47 million above the street's estimate of 6.47 billion. That top-line beat was driven by same-store sales growth across all three geographic segments. U.S. at positive 3.9%, international operated markets at positive 3.7%, and the international developmental licensed segment at positive 4.1%, confirming that the value recovery is a genuinely global story.
The big unlock on comps is the return of traffic. McDonald's has been executing its value strategy, the $5 meal deal, bundled value offers, and digital loyalty promotions, and Q1 shows that strategy is pulling customers back. After a genuinely difficult 2024 that included the E. coli contamination scare and prolonged consumer resistance to higher prices, the brand is demonstrating clear recovery traction at both the traffic and ticket levels.
Operating income came in at $2.95 billion, a 45.3% margin, essentially flat with prior year levels. That stability is impressive given the ongoing value investment. McDonald's is absorbing the cost of promotions and loyalty offers while still delivering franchise economics that keep system operators profitable and committed to the brand.
Net income reached $1.98 billion, a 30.4% net margin. Adjusted EPS of 2.83 cents beat the consensus estimate of $2.74 by 9 cents, a 3.3% surprise. This marks 4 consecutive quarters of positive EPS surprises, rebuilding investor confidence after a rougher stretch in late 2024.
Free cash flow remains the crown jewel, $1.64 billion in Q1 alone, contributing to a trailing 12-month total of 7.19 cents. McDonald's deployed roughly 1.06 billion in capital expenditures, primarily restaurant reimagining and new unit development, while returning capital through its 6.67 per share annual dividend. The balance sheet carries $54.8 billion in total debt, typical for this franchise-heavy capital structure, offset by exceptional earnings power.
The bull case starts with the comps inflection. For 3 consecutive quarters, McDonald's had been struggling to generate positive same-store sales growth in the U.S. as value-fatigued consumers traded down to grocery or cheaper fast casual alternatives. Q1's 3.9% U.S. comp growth, the strongest in 5 quarters, suggests the affordability narrative has decisively shifted back in McDonald's favor.
The loyalty program is the structural driver that didn't exist 5 years ago. McDonald's now reports 175 million plus active loyalty users globally, a population that visits more frequently, spends more per transaction, and responds to targeted digital offers with measurable conversion rates. Digital loyalty orders carry higher attachment rates for premium items and beverages, improving the overall ticket without requiring price increases that risk traffic loss.
Internationally, the Middle East market is normalizing after significant disruption from the conflict-related consumer boycott that weighed on 2024 results. As geopolitical tensions ease and consumer sentiment recovers, that segment is positioned to be a meaningful positive comps contributor, particularly for the back half of 2026 and into fiscal 2027.
From a valuation standpoint, MCD is trading at approximately 22 times forward earnings, near the low end of its 5-year historical range. With $7 billion in annual free cash flow and a $201 billion market cap, the FCF yield is approximately 3.6%. Combined with a growing dividend, total return potential for long-term holders is compelling, especially relative to peers Yum Brands and Restaurant Brands, which trade at comparable multiples without McDonald's scale advantage. Bears point to the structural affordability trap. McDonald's has trained consumers to expect deep value, which compresses the ticket size and limits near-term EPS upside. The $5 meal deal and similar promotions are traffic positive, but margin neutral or slightly negative, a trade-off that works only if volume scales enough to offset the per-transaction pressure.
The balance sheet is a recurring concern. $54.8 in total debt, even for a franchise model, limits financial optionality. Rising interest rates add to carrying costs, and any sustained slowdown in free cash flow generation would force difficult capital allocation choices between dividends, buybacks, and debt service.
Labor costs in European and Asian franchise markets continue to rise, compressing franchisee-level margins. If franchisee health deteriorates, royalty flow-through declines, a slow-moving but real risk to McDonald's top-line durability.
Consumer sentiment remains the primary near-term risk. McDonald's operates across multiple economic demographics, but the value-seeking consumer can shift quickly. If unemployment rises or disposable income contracts, even QSR traffic can compress, as 2024 demonstrated.
Commodity costs are an ever-present variable. Beef prices, chicken prices, and packaging costs have been relatively stable in early 2026, but any supply shock, drought, avian flu, geopolitical disruption to shipping lanes can compress restaurant-level margins and force McDonald's to absorb costs rather than pass them to an already value-sensitive customer base.
Competitive intensity is real. Burger King is executing an effective value messaging campaign. Wendy's breakfast expansion and new value tiers are pulling morning traffic. Chipotle's price point has come down relative to consumer perception of quality. Fast casual and QSR are all competing for the same wallet simultaneously, and the winner of any single quarter can be a different story the next quarter.
McDonald's financial health is exceptional from an income statement perspective and intentionally complex from a balance sheet perspective. The $54.8 billion total debt load is a structural feature of the franchise model. McDonald's owns the land under many of its global restaurants and leases it back to franchisees, a real estate asset strategy that generates a rental income stream alongside royalties.
Cash on hand of $774 million is modest relative to the debt load, but FCF coverage is exceptional. $7.1 in trailing FCF versus approximately $1.4 in annual interest expense, yielding a coverage ratio above 5x. McDonald's has never missed a dividend payment since initiating it in 1976, and the current 67 per share annual dividend consumes roughly $4.7 annually, well within FCF capacity.
Return on equity is stratospheric by conventional metrics, technically negative book equity, due to the cumulative effect of share buybacks and dividends exceeding retained earnings. This is a sign of financial sophistication, not distress. McDonald's is a franchise royalty machine, returning capital at a rate that exceeds its book investment.
Options positioning ahead of Q1 2026 earnings reflected cautious optimism. Implied volatility was elevated relative to McDonald's historical average, suggesting the market expected a meaningful move in either direction. The actual reaction, relatively muted on the day, implies that the market had partially priced in the comp's recovery narrative.
Call open interest was concentrated around the $290 to $300 strike range heading into earnings, indicating that options traders were betting on a modest bounce from oversold levels near the 52-week low. With the stock still below $285, those calls are slightly underwater, suggesting the market wants more evidence of sustained comps improvement before rewarding the stock with a premium re-rating.
Insider activity shows a pattern consistent with a management team confident in the long-term thesis but not overtly bullish in the near term. CEO Christopher Kempczinski has not sold shares recently, and the overall insider posture reflects a conviction that the current price represents fair to undervalued relative to the franchise system's earnings power. Net insider activity is neutral, neither a sell signal nor a strong accumulation signal.
The street remains constructive, 37 buys, 24 holds, 1 sell, consensus buy, and an average price target of $352, implying 24% upside from current levels. Analysts broadly credit the comp's inflection as the key catalyst for multiple re-expansion. The next test is whether Q2 sustains or accelerates the traffic recovery, which would unlock the next leg of the investment thesis.
Charged alpha content is for informational and educational purposes only. Nothing in this episode constitutes financial advice or a recommendation to buy or sell any security. All investing involves risk, including the potential loss of principal. Do your own research and consult a qualified financial advisor before making any investment decisions. Past performance does not guarantee future results.
Ooh, we do! That That ticker tape starts dancing fast, a bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.